Welcome back. Let us proceed with our lesson. Now we will look into long-term and short-term insurance. So the focus here is on the examples of short-term and the examples of long-term insurance. So with your examples of insurance or events that may be covered for long-term or short-term insurance, we are talking about property insurance that can be taken. We are talking about theft, which is also covering short-term insurance. We are also talking about burglary and fire, and you would realize that all these now examples would lead to compensation and would also be taken by businesses or would be taken against assets. But when you look now into examples of long-term insurance, you'd realize that we are talking about endowment policy here, we are talking about life insurance, we are talking about retirement annuity, pension fund or provident fund, and also we are talking about disability policy. So all your long-term insurance would be applicable mainly on human life. They relate to humans. But when you're looking into your short-term insurance, they are applicable to assets, because when we are talking about property insurance, we're talking about covering an asset. When you're talking about theft, to say should an asset be stolen, then we take short-term insurance on theft, and then we also have burglary and fire. So all the short-term insurance have to do with an asset. But when you're looking into your long-term, they are mostly applicable to human lives and the principle of security that we spoke about when we were looking into the differences. Then, now we look into insurance concepts. We'll start by looking into the first insurance concept, which is over-insurance. Over-insurance is when the item is insured for more than the actual market value of the asset. So this is to say insurance is taken, but on what now? On an asset, but the insurance is being more than the actual value of the asset. And I'll give you an example to say what do I mean with that. And then businesses will not receive a payout larger than the value of the loss at market value. So this is to say, because we are talking over insurance, we are saying the asset is 1 million, for instance. Let's say the house is 1 million or the car is 1 million, but the insurance taken on this house, which has the value we call 1 million. The value is 1 million, yes, but the insurance taken or the cover taken on this asset now is 120 million. So this is more. This is more than the value of the asset. So this does not mean if the business has insurance that is more than the value of the asset, it does not mean the business will receive a payout larger, because they may want to use the idea that insurance is more, therefore we are going to receive more should a damage happen. So that will not happen. And then this means that extra money paid by the premium will not be paid out to the insured if there is a claim for a loss. So that's what we mean there, to say should any damage happen, then you will not receive more money, because you will only receive money in proportion to your asset. So this would happen to, for instance, a car. We know that a car loses value each time it is being used. So for instance, if you bought a car in 2019, and should it happen that you took insurance for maybe a 200,000 car, you know that now in 2022, now your car is no longer 200,000, it will lose value. So it means now if you are still paying for insurance for 200,000, you are losing, and you are paying basically over insurance, and you will not receive more when it comes to the claim should any damage occur, like you see in this picture. Now let us move to another aspect, which is under insurance. Under insurance occurs when property or assets are not insured for their full market value. So this would normally happen to a house, because a house appreciates or it adds value over time, and then the asset is insured for less than the current value of the property or asset. Then another aspect we should know about this is that the insurer usually applies average loss to calculate the amount of loss that must be compensated to the insured. So this would happen, as I said, to a house, to say now you are insured, maybe for instance for your house is 500,000. So if your house is 500,000, at the beginning when you bought the house, you took insurance for a house that is worth 500,000. But your house after 2 years appreciates. So it means your house now is 700,000, for example. So if your house is 700,000 and you are still paying insurance for 500,000, it means you are underinsured, and should a damage happen, you will not receive the full amount regarding the damage because you are underinsured. Your house is now 700, but you are paying insurance for 500,000. So that is what we mean for with the term underinsurance. What is applicable there is the term now, another insurance concept which we call now average loss. What do we mean by average loss? Average loss is a stipulation set by the insurer which is applicable when property or goods is insured for less than its market value. So this is when now property is underinsured. The insurance company would apply the clause we call average loss. This means that now the insured is responsible for part of the risk that is not insured. And then as we proceed, note the average loss is applicable when goods or assets are underinsured. That's what we mean there. So calculating average loss. Average loss has to be calculated. So this is the formula. We're going to say amount insured over value of the insured item multiplied by the amount of damages or loss there. So let me give you an example. Peter owns a thatched house which is valued 1 million, and he is insured, or he insured his house with Pro Covers, which Pro Covers insurance for 800,000. The kitchen was damaged by fire, and the cost of the damage amounted to 30,000. So how do we substitute? We say, what is the amount insured? Amount insured there is 800,000. So we're going to say 800,000 over value of the item. How much is the value of the house there? The value of the house is 1 million. So we're going to say 1 million. Then you say multiply by the amount of damages. When we are talking about the amount of damages, we're going to say now, how much is the amount of damages? Amount of damages is 30,000. Then your answer should be 24,000. So when we are saying now when property is underinsured, part of the risk will be taken by the owner or the business. We are saying now the total amount of damages is 30,000. So this is to say, if the insurance company will pay 24,000, it means the 6,000 will be paid by the owner of the house, which is Peter in this case. So that's what we mean when we are looking into your average loss and how the insurance company would deal with the situation of underinsurance. Then we also have another insurance concept which we call the reinstatement. It is a stipulation where the insurer may replace damaged goods instead of reimbursing the insured. So this is to say, should any damage happen now, the insurance company will reinstate or replace the damaged goods instead of reimbursing, meaning instead of paying more. So this stipulation is applicable when property or goods are overinsured. Hence we see now the understanding that now there will be replacement of the goods instead of reimbursing. This is because of the stipulation which we call the reinstatement, and is applicable when there is over-insurance. And then the reinstatement value will not be higher than the market value of the loss. So this is the situation. The situation would be the house now is 1 million, and then the insurance amount is 120 million. So with that, this means now the insurance amount is more. So this means there is over insurance because the house value is 1 million. So this is the value of the house. So this is to say, should anything happen or should the damage be 1 million, the owner will not receive 120 million, but the owner will be returned to the same financial position. The insurance company will only give the owner 1 million. Hence, we are saying they will not be reimbursed. So that's what we mean with that. Then the insured is returned to the almost the same financial position as before the loss occurred. So that's what we mean. They will be returned to the same financial position before the occurrence of the loss. Then we have the term excess. Excess, what do we mean by that? This is a portion of the insurance claim that the insured will have to pay towards the cost of replacing or repairing the goods or property concerned. So this is to say, before a claim can be processed, the insured or the business has to pay what we call excess. Now, excess payment keeps the insurance premium lower and they discourage fraud. That's one. Then another issue is that now with excess, the insurer needs to protect themselves from fraudulent claims. Therefore, excess payments are a good way to do this, as the insured is less likely to submit false claim when he or she needs to pay an amount upfront. As we said, this is an upfront payment that is made. Now, as we proceed, excess payments prevent the insured from claiming for minor damages that might have occurred to the asset. So that is another way in which excess is applied, and this would definitely benefit the insurance companies from any fraudulent claims that may occur. And as we proceed now, we look into the last part of our lesson, which is the differences between over-insurance and under-insurance. Now let us deal with that. What do we mean now, and what is the differences between over and under insurance? Over insurance, property or assets, when we are looking into over insurance, that are insured for more than their value. To say this insurance or the insurance company is receiving more for an asset that is worth less. Whereas when we are looking into under insurance, here we're talking about property or assets that are not insured for their full market value. So that's what we mean there. That is the critical difference between the two. Over insurance, property or assets are insured for more, but then when you're looking into under insurance, property or assets, they are not now insured for their full market value. So with over insurance, the insurer can choose to reinstate the insured, whereas with under insurance, the insurer will implement the average loss, meaning the calculations we talked about, amount insured over market value multiplied by the damages to determine the amount that will be paid. Hence, we talk about applying now average loss. But when it comes to over insurance, the business or the insurance company would apply reinstatement. And then when you are looking into over insurance, again, businesses will not receive a payout larger than the value of the loss at market value. Whereas under insurance now, businesses will only be paid out for the amount that the goods or assets are insured for. Because we are talking about under insurance, we are talking about less amount or an amount that is lesser than the full market value. So those are the differences between over and under insurance. So with that being said, this is the end of our lesson. So we will be ending our lesson and hoping we gave you some more knowledge or an insight on insurance. And thank you for watching our lessons.